Have you ever wondered how hedge funds manage risks, make money, and thrive in nearly any environment? Well, my next guests are hedge fund managers, and they are about to tell you their opinions on just that. All this and more coming right now. Here we go. Hey, welcome to another episode of Making Billions. I'm your host, Ryan Miller, and today I have two of my partners, Hedge Fund Masters, and my very best friends, the Kevin Kwong and Dr. David Yeow. Both Kevin and David are general partners with me at our fund, Pentium Capital Partners. They run our Pentium Atlas hedge fund, and I have agreed to bring them onto the show, and they're going to share with us some of their opinions on the market and how to get started and some of the potential pitfalls you want to avoid along the way. So what this means is that David and Kevin both understand how markets work, and they are about to share their unique perspectives with you and I about hedge funds, markets, and where they believe the smart money is going, all without soliciting investors from the show. So David, Kevin, welcome to the show, my brothers.
Ryan, thanks for having us. I know you're a busy guy and appreciate you inviting us again. Can't believe it's been a year. I remember the last time we were on the show, it was just when you first started, and I can't believe how consistent you are with the show. It's amazing. And we've been a big fan, and happy to jump back on and now part of the team together. Yeah, and just have a good chat.
Awesome, man. Well, it's so good to have you. And yeah, actually, it's been probably close to 2 years by now, if you can believe it, right? So you were some of my first fans and first guests on the show, and I'm so honored to have you back. Look at how the times changed. We're all partners now. So yes, full disclosure, I do have an interest in what these gentlemen do. We're not soliciting investments in any way. We're just having a discussion, sharing our opinions on what's going on in the markets. And these are some of the best guys I know to make that happen. You guys have been running fund. You're on your third fund now. We have a lot of emerging fund managers that listen to the show, among many other people, family offices in over 100 countries around the world. Just addressing the beginners out there. Why even start a hedge fund? What's the point? Why start a hedge fund? Why do you guys trade? Bring me up to speed of why.
Yeah, I'll take this one. I think, hedge fund by itself is a great business. I think trading itself, it's, when done correctly, you can structure it like an insurance product and be relatively consistent return. And you can make it with, relatively like defined and low downside risk. And I think there's a lot of misconception in the trading world. I think it's just because trading world is such a big arena, right? You got people trading equity, Forex, bond, options, derivative, all kinds of swap, all kinds of stuff. And I think it's sort of like walking into an arena where some people are playing basketball, volleyball. I think too many people are trying to jump from one sports to another a lot of times. And that's why, they don't find any success. Whereas, it's kind of like guys who are doing real estate, multifamily guys tend to stick to multifamily. I think there's less of that structure in trading because there's so many options. You can really trade everything except maybe humans and organs. Yeah, but overall, it's a great business. If you really think about it, trading, you don't have a lot of, operating expenses. You don't have utility or payrolls or, insurance or, overhead. So trading itself, it's a pretty high profit margin business or income stream compared to a traditional business. And, in the words of Aaron Bear, which I'm a big fan of in the Making Billion podcast, he says, you want a scalable business and you want something that's predictable, scalable, repeatable, and sustainable. That still really stuck with me after that, listening to that episode. And this is why I follow the show. You get all these great nuggets. And I think trading whether you do it as a supplemental income or as a business, it's really done right, again, properly with the right education. I think you can find great success.
Yeah, scalable, repeatable. I loved all that. And yeah, Aaron has become a great friend to us, the fund, to myself. He's a wonderful human being, and I hope he's listening to this show. So that being said, let's continue on that same vein, David. Thank you for that. Let's talk to the beginners out there. You've been a beginner before. Kevin, you've been a beginner before. I've been a beginner before. We just lock in on anyone who's been in the industry to give some advice. So addressing the beginners out there, I'm curious, two things. From your advice and your experience and your opinion, how can beginners win? And then maybe we'll follow up with how do they not lose? How do they avoid blowing this up? So what would you say to the beginners who are looking to add some points on the board without screwing it up and getting wiped out? What would you say?
Yeah, I'd say for the beginners, invest in education. I'm a student of Scott Bauer. I learned how to do favorable risk reward trades with debit spreads and define losses when I first started. And then I met Kevin and David's son, and they taught me about systematic trading, which is mind blowing to me at the time because I was always chasing high volatility, earnings, and technicals. And with the systematic trading nowadays, it's better quality of life. And you have a lot more predictability, you have a little more control, and you don't have to watch the screen all the time. And it's an evolution, but I'd say for the younger newcomers, invest in education.
Okay. Kevin, where would you say? So invest in education. That's how you get some early points on the board. So if you're a beginner, conduct your research, understand, learn as best as you can. Kevin, what have you found to be some great sources from you in the early days of how you learned and really came up through the ranks? Where would you recommend beginners invest in their education?
For sure. I think
just like what David said, education essentially is the most important thing I have invested in. I started in the Hong Kong equity market for many years, and there's forum online and courses that I will follow and learn from. Then in the US, I ran into a person called David Sun. He's a good friend now, a fellow hedge fund manager. He's one of the best and the smartest mechanical traders I've met. One thing we did really well through that process is to learn one thing and do it really well. And from there, you can branch out and you can do different type of trading and whatnot. And one thing I want to mention is it's important to make money, but it's also important to not lose money. And what do I mean by that is, as a trader, investor, or portfolio manager of a hedge fund, what we have to understand is the leverage and the risk behind a portfolio. General guidelines for me, for the funds, and just for a good risk management protocol, I would say there's 4 things we typically look at. Okay. And first thing is we want to make sure the strategies that we deploy is at least one sharp. And this way, the risk is relatively low and the return profile makes sense. Then a good sharp only matters if you have good sizing as well. Because if you go all in and you just have that one time that you actually lose, then your account's gone, right? So they call it VAR, which Ryan talks quite a bit about. Value at risk is something that we really look into and follow. And we want a single trade to be less than 2% at risk at a given time to the portfolio. Then last 2 things is, this is super important to our fund, is minimizing drawdown, right? So it's good to focus on profit, but it's also important to focus on how much risk you're taking, right? Instead of focusing on profit, you can actually focus on risk. Like, and what is the risk before you are putting on a trade? Lastly is expectancy. Like I mentioned, positive expectancy and proper sizing of your trade will ultimately help create a successful trading career, hedge fund, or a portfolio.
Yeah, I love that. You remind me, when I graduated, my wife and we got married in grad school. No, this is not a dating podcast, but bear with me. I'm going somewhere with this. As we graduated, we're getting to know each other. And she's like, okay, so you got an undergrad in finance, you got a master's in finance. Did you learn anything different? And hopefully I did, because I should get my money back, but I really did. And, I thought about it for about 10 seconds and I said, you know what? The difference, I think, in my thinking from undergrad to, and this complements what you're saying, Kevin. I said, when I was just starting out, I really just looked at upside. And I remember when I was, a million years ago, Facebook was IPOing and, you throw your only $100 as a starving student into it, hoping it'll turn you into a millionaire. And all I ever looked at when I was brand new, did not know what I was doing, but I wanted to, is I only looked at upside. And while that's important, obviously upside is growth and it helps us to get paid. It was after grad school where I really started to understand exactly what you're talking about, is to say, sure, yes, you need upside, obviously. But if you do not cover your risk, you may not live long enough in this game to even see the upside, the sunny days. If you're not positioned to make it through the winter or the dark nights or however you want to put this. So you really have to mitigate your risk and understand that. And so that's just my perspective. And value at risk, folks, for us noobs out there, value at risk is just saying, if this whole thing blows up, what's the maximum amount that we could lose? What's the value at risk? And so Kevin is saying, should never be more than 2% of your portfolio. Now, obviously, there's probabilities and there's all kinds of things in there. We're not giving you advice. We're just saying there are mechanics out there that if you're ever interested in launching a fund or just trading on your own personal account, whatever you think is right for you, talk to a professional advisor, but just make sure that you appreciate, don't be dumb like I was in the early days where you just saw the upside. Make sure that you're following what David and Kevin are saying. These guys are pros. They know what they're doing, and really appreciate the risk, not only for your sake, but for people who are investing in you or backing you. It could be your mom, could be your spouse, could be your family capital. Whatever it is, all we're saying is you have a responsibility, and that responsibility includes managing risk. Would you say that's a fair summary?
Yes, risk reward is important, coupled with win rate, right? A lot of people, when they first start, I hear about, they just focus on win rate. But then, what happens when that one time you lose wipes everything out? You don't have expectancy. So it's really important to couple risk reward, understand that if you have a 4-to-1, 5-to-1, what percent of win rate do you need to break even, to be profitable? I think those are good fundamentals to stick to. That'll help you understand how to mitigate your downside.
Yeah, I love that. I'd love to shift gears on that. So we talk about risk management. We gave some tasty nuggets for people who are beginning. Kind of reminded me of my early days. Let's shift into the market. Thank you for watching. If you've made it this far, we must be friends. So don't forget to like, subscribe, and click that notification button. Now, let's get back to the show. Now, obviously what you guys do, and all of us, this whole show is on private investments and alternative investments, but in the market, we're subjected to a lot of it. Now, the cool thing about what you guys do is you have data around that. So I'm curious, reading the tea leaves or the matrix charts that you guys do and working that magic, I'm really curious. What are you seeing? Where's the market at? And maybe we can talk about where you see it heading. Where's the smart money going? But first, what are you seeing out there?
Oh man, we could talk about this all night.
And we have many times.
Yeah. I think as long as oil stays elevated, inflation is going to stay high. It drives everything else, travel, from food costs, transportation, logistics. I think the Fed has no choice but to keep the rates high for as long as they can until, consumer spending and job starts weakening. Then you have to look at the other side, right? Is the job market actually truly strong, or just people just losing these $200,000 job and getting two or maybe $90,000 jobs instead? And if you look at the job data, it seems like a lot of the new job created are government-related jobs. I think Kevin brought this up to me 4 days ago, and what he mentioned was back in the days, the investments, the capital were all going to technology, which is deflationary. But now capital is going to all these, what do you call them, Kevin?
People, essentially, right? So
welfare programs.
Yeah, welfare program, the system, and as you can imagine, Ryan, and David mentioned too, if you lose a $200,000 job and let's say there's a $50,000 job that's created, on data, it shows that, the job market is amazing, a lot of job openings. But in reality, the saving rate and the spending rate and all that is completely different. And the behavior is completely different as well. So as you can imagine, more lower income jobs sometimes create a higher demand as most of the money is actually spent. So to understand the market, really have to understand why inflation is sticky, why certain data is coming out as favorable, but in reality, it's actually not the best for the economy.
And to be told, I don't really care about, that's the beauty of what we do, is we basically, be systematic and do the same thing over and over again. And we are able to capture an alpha. While it's entertaining to follow, what's going on at the market, the earnings of all the big tech, what's going on in AI, it's exciting. But a lot of times what we learn over the years, the best way to lose money is to go into anything new and exciting.
Can you unpack that a little bit? I'm curious of what you mean by that.
Yeah, just look at what kind of, FTX, for example, right? It's exciting. WeWork was exciting, right? And Theranos was exciting, was game-changing. It's the quickest way to lose capital. It's quick, because it's exciting and it's just not what we do. If I don't understand it, a lot of times I won't invest it. It's a good, I think that's a good advice. I forgot who said it. But yeah,
I remember just to chime in. I remember to say, I remember Warren Buffett, I believe, is a credit to say, if it doesn't make sense, it doesn't make sense. So and I think that it kind of is reminiscent of what you're saying. Is just like there's a lot of these new things and they're flashy, and there's a difference between is it in fashion or is it just a fad? And so a lot of these fads come and go, but it's not solid. And so I think if I'm picking up what you're laying down is you're just saying, look, there's a lot of these new things that come and then they go. If you remember, it was literally, it feels like 5 minutes as well as 5 years ago when everybody was like Web 3.0. Remember VCs were going hard. And then just like overnight, they're like, what's that? It's all about AI. And so you see these things flip on a dime in these markets, all these new shiny things. And I'm arguably literally part of that machine. So I'm making fun of myself on that one. But I think what you're saying from your opinion and your perspective is to say, that's not a great way to run a hedge fund, in your opinion. Am I getting that right?
Yeah, I think running a hedge fund is one thing, but it's just, we only hear the good stories, right? Oh, people make 1,000 times their money or whatnot. But obviously every successful unicorn, VC or investment comes with maybe 99 or 900 that failed or that broke even, right? So at the end of the day, diversification is important and understanding the type of investment. And obviously, one thing Ryan talked about is having access to good people and invest in good deals that people that you can trust is always important. And just piggybacking to your question though, Ryan, regarding market, like our thesis is people don't really know where the market, no one can really predict what's going to happen. We can only rely on some of the data and look at the probability. Right? At the end of the day, this year, 2024 is an election year, and historically, election years are bullish. So we have that in mind, and we look at the probability of that happening and kind of position ourselves accordingly. However, we believe the best way to truly manage a portfolio on an institutional level is to be slightly more agnostic to what the market is doing. And that way, you can actually position based on true data, systematic, scalable, mechanical, and repeatable approach so that you can trade and generate alpha over time, regardless of what the market is doing. So I think that's always been the philosophy of the funds that we've started, is to essentially be delta neutral, if you will, or just uncorrelated to the broader market.
And that, I think, ties into some of the work that you guys do, your view and perspective on the world and how to trade, is to say, because it's unpredictable, we literally trade like we don't know what we're doing. You didn't say that, and just say, look, let's just pretend we can't predict the market. It's when people pretend that they can, I think, just my opinion, it's when people believe they can predict the market, otherwise known as a speculator, that they start trading like it and they lose their cheeks. In the second they're wrong, they lose it all, right? That's where we talk about VAR and all these different risk metrics and all these things that you have in place. They're like, I don't need to know about any of that. And trust me, I've done that in the early days. I was like, I don't know. For example, I like Facebook. Facebook's going to go to the moon. It's going to make me a millionaire off $100. You're an idiot, right? I'm speaking to my old self. And now you're saying, look, you can't predict it. I remember the time when I was fortunate enough to hang out with Warren Buffett, and he taught me that the market can remain irrational longer than you can remain liquid. Meaning, like, sometimes it just doesn't make sense. The market completely goes against conventional wisdom. And so if you trade like, hey, anything can happen, and you build your thesis around that, which in my opinion, you've done that, is to say, we actually can create a type of thesis where we trade our funds, and we do that in a way that just says, hey, anything can happen. Let's be ready for anything. Would you say that's a fair summary?
Yep. You got to assume you're wrong. Just because you trade the future or whatever doesn't mean you're a fortune teller, right?
Exactly. And one of the worst things, maybe the best things, but one of the worst things that could happen to you is you make a trade and you get lucky and you just think, I got it. The markets are so easy. I got this. You're like, okay.
Yeah, I mean, true life examples too, right? Like last 2 weeks has been volatile. We trade our fund, we get stopped, but we understand the expectancy, right? So it's part of the whole equation. You lose some trade. It's impossible to win every single trade. But as long as the expectancy, the correlation, and the whole portfolio is set up so that for us, it's a slightly neutral beta, if not just low beta. That way, over time, we can just let the statistic and the math to truly play out.
So a lot of things we trade are, go into deep research, starts from deep research, right? And then you look at the stats and you look at everything else from liquidity to sizing. Like you said, just because you got it right once doesn't mean you size up and go all in, right? That's when mistakes happen. So we trade with a lot of these things in mind, and we remind each other as well.
Yeah, good to have you brothers on the case, is to triangulate, hunt like raptors these stocks. It's great. Well, I guess in your case, these derivatives. Shifting gears around third base, let's leave some competitive advantages for people, right? So if someone was able to talk to you and they say, I love what you do, big fan of what you do, I'm starting out, can you give me advice you wish you had? What would you tell them?
I'll start, David. So when it comes to the beginning, right? So investing in education itself, I think that was super important. And from there, what we've learned is the continued education will open up a lot of different doors, right? And from there, we believe, like we kind of talked about earlier, Ryan, is alternative investment is something that is more and more popular, one, and it's more and more critical given the current market situation. And what I mean by that is, if we look at the average return of the last S&P, the last 30 years, we're looking at around 9.6%. And versus the last 10 years is 12.68%. So we can see that there's a pretty significant return difference the last 10 years versus the average. So a lot of data is showing that the last 10 years might have borrowed the future gain, and this might have to revert back to mean. And another important part is the last 30 years might also close to 40 years, it has been like easy money policy. What that means is the Fed or the government, everyone's printing money and they're investing in the companies and really driving the economy. And through this process, the average gain was 9.6%. From a true globalization period to potentially a more nationalist or not protectionism type of economy, we can kind of see the shift in the regime and there might be a lot less liquidity, a lot more restriction that is building up in this world. Where I'm going at the end of the day is the return might be a lot less, and we sometimes call it the lost decade. So if we look at the next 10 years, the S&P or the broader market might be pretty flat. And if that's the case, inflation is high, return on stocks or investments are low, then that just creates a huge real loss when it comes to their portfolio.
So we're dancing around the stagflation type of economic scenario, it sounds like. And so we always make a call and make a prediction, and then obviously cover your positions if you might be wrong. And so sometimes folks, I've heard David and Kevin use these big words, mean reversion. Okay, it sounds really cool. So basically it says there's a long-term average of 8% in the S&P, like you were saying, but the recent average is about 13. And so what that means is there might be a reversion back to the mean, which says it may not be as bullish as you think. And so going back to that, there might be some slow declines on that, I think is what I believe I'm hearing from you, Kevin. Is that right?
Yeah, that's absolutely right. One thing I want to add is during this period of time where it's high interest, there's a lot of newer products that come through that can truly increase the capital efficiency and the way you structure your portfolio. And one example that our fund has been doing is a product called structured product. What that means essentially is a product that includes the link to part of it to the interest, which is currently around 5% from the treasury bill. And you use that as a good collateral and trade options or derivative or even long equity. That way anything you do is on top of what the treasury bill, the T-bill is paying. So that's a really smart way and capital efficient way to structure something that can provide great value to investors. Last thing I want to mention about that structured product itself is at the end of the day, because they are so uncorrelated, which we talked about a couple of times, like T-bill is uncorrelated to our core type of trading, so not correlated to our shorter term type of trading. When you blend a portfolio like that, it's not just return that you are getting, but it's actually lower risk. And I think that ultimately is the biggest advantage you can get is to have a low risk, low beta, but high alpha portfolio.
Yeah. I've been talking to a lot of family office, and I've been finding a lot of them are having more and more allocations towards alternative. And I asked them why. And part of the big reason is because they do think the market could have a decade of going nowhere, and in traditional investment, like, your 60 bond, stocks, cash. So they're looking into alternative, like even more allocation towards like more high risk VCs, startups. I think going back to education is to the listeners as getting educated in whatever, alternative that you're looking into investing and getting some understanding of what you're getting into, whether it could be wine, art, real estate, but, specific niche. It could be like data center, you try to storage center or, multifamily, whatever it is, right? Get some education, get comfortable and know your risks and size your allocation properly. And to the extent that you're willing to, you understand what you potentially could be losing. And I think you can get a lot of asymmetrical return over the long term, especially in the next 5 to 10 years.
Okay. I love it. I ask a lot of people this when I talk to them, and you're no exception. So I'm going to ask you, where do you see all the smart money going? Like where in your opinion, where do you see smart money going?
Yeah. So David mentioned talk to different family offices, and smart money is truly going to a lot of alternatives. And where we can see that especially is the large institutions, endowments and whatnot. So I read somewhere, and it's Ryan, you might find it interesting, is the Yeow endowment, Harvard endowment, they actually have over 60% in alternatives like VC, private equity, and hedge fund. Yeah. So specifically, the newest September 2023 newsletter that Harvard came out with, the endowment fund, they have 39% in private equity, 31% in hedge fund, and only 11% in US equity. So if you look at it that way, I'm like, you might think, oh, why are smart money doing that? Why would they not just put in S&P and just ride it to the moon, right? The difference is the institutionals are kind of agreeing what we also seeing is that there's a asymmetrical risk to reward in the market going forward. Market seems amazing right now. There's a lot of liquidity, a lot of support from the government spending and whatnot, but liquidity will eventually have to end, right? And ultimately, with the liquidity, with the uncertainty, there are a lot of inflow to alternatives like our fund, VC, and even like crypto and whatnot. So at the end of the day, it's about portfolio allocation. Pick your favorite crypto, go buy it, but don't put all your life saving in it, right? So it's just have to be smart, like what David talked about. Get the education, understand what the crypto is about. But there are a lot of different investments that might generate a lot more return with a lower risk compared to the broader market the next 10, 15 years.
Yeah. So I think what you're saying is just look for those asymmetricals, more return than risk, whatever that might be. So we're not obviously giving financial advice. We're just saying like, yeah, that's probably a good thing to lead your research and discussions with other professionals, is just saying, where can I get a disproportionate return given the risk that I'm taking? I love that. You're going to say something to add there, David?
Yeah, I think just to be entertaining, I think anybody who was working a job, right, to think about like how many people reaches financial freedom through the 401k, right? Do you really want to be ignorant and just leave your financial fate to somebody who don't even remember 2008? All this, you think about it, right? The newest grads out of all these analyst groups are 8-9 years old, 2008. So that's why I pull all my money out of when I left the day job. And I manage it myself. I trade it myself. My family, no one cares about your money more than you. And the government's stuck in a hard place. Yeah. They are printing, what is it? Like, we're printing $1 trillion every 100 days, just in interest on the national debt. How do you get out of that? Print more or raise taxes. So either way, you have to be ready for more expenses. Top of inflation. So
that's it, you put it well, man. The government's in a tough spot, and the people recommending these analysts that are making recommendations that other people who trade on their 401k. I think this is what you're saying is, these people they were 9 years old or around there when '08 happened. So they don't have that level of experience of rough economic cycles to really draw on and guide their experience to say, and I remember learning this, it was a study that was done that showed there actually is an upward bias in a lot of analyst reports, and they would test them and they would spin the wildest thing. Now, we're not saying they're wrong. We're not saying they're doing a bad job. We're not really saying anything. We're just saying, do your own homework. And sometimes there's research out there that you can rely on. But I think what David, you're saying is like, but also if you do your own homework and really trust in yourself, you can also have a voice in the destiny of your financial future rather than just relying on people who are 9 years old back when proverbial blood in the streets. And so really make sure you do your homework. Have a great team around you like I do. You guys are on my team. I'm on yours. And, it's certainly an honor. Just to wrap things up on that, is there any final words that you have that you would like to mention? Any ways people can contact you? Anything at all? Closing remarks.
Yeah, they can find me on LinkedIn. Just look for my name.
Okay. David Yeow, Yeow.
Yep. And I would say, if you're looking for opportunities, the best way to do it is by maintaining a good reputation and relationship.
Sounds familiar. I love that. Yep. Reputation, relationships are the two most valuable assets in your possession. We say that all the time, David, and you're certainly a walking testament to that. What about you, Kevin? Any closing remarks?
Yeah, you can find me via email. Probably the best way would be kevin@pentiumcapitalpartners.com. And closing remark wise, Ryan, you used the word stagflation, right? And I didn't want to alarm the audience or whatnot. So that's why, but there is a probability, right? We've been talking about expectancy, probability, and just think that if stagflation does happen, what would be the best type of opportunity out there? We're talking about high inflation, pretty minor economy, right? So, or like flat economy or even a recession. So if we look at it that way, then we can understand what is happening in the world and why certain asset class is doing better. Commodity, gold, crypto, and whatnot. So I would encourage listeners to, we talked about, do more education, research, and kind of learn different, instead of just reading the headline data, truly understand why certain situations happening, why inflation is sticky, and whatnot. But with that, I think if we focus on having a good balance portfolio, I know Ryan, you really likes to say at the end, it's like you too can also make billions.
That's true. Yeah, I love that.
I told you, we can talk about the market all day.
Well, one of my favorite subjects. So I'm a knockout at parties, that's for sure. So that being said, just to summarize, some of the competitive advantages, alternative and structured products have never been more important than they are right now. People are investing in those, and it would appear that the smart money is directly going into that area at eye-popping rates. So investing in those things, following what David and Kevin said, in their opinion, doing these things will put you on the path so that you too can enjoy your pursuit of making billions.